a physical loss to their own asset. Some of the typical causes are embargoes, confiscation, terrorism, strikes, political violence, blockage of waterways or closing of ports, natural perils such as hurricanes, which we've seen here on the East Coast, and other windstorm type events.
Michael,
another
I think
thing.
you and I chatted a while back that you were really enveloped with this hurricane. Your clients were calling you all the time and asking for your advice. This insurance would be critical during that time, wouldn't it?
It would absolutely be critical at this time, or at times like these. A lot of my clients who are down on the Gulf Coast, for instance, they are well prepared for a hurricane. They have their plans in place. They have their generators ready to go. They've lived through these things, and they know what they need to have in place outside of insurance. But with the recent hurricane that swept up the East Coast, many of my clients, they really didn't know what to do. They didn't know what their insurance even did for them, let alone having some type of contingency plan in place, if the hurricane were to disrupt their business. So yes, this type of coverage would definitely come in handy, Andy.
Great, keep going. I'm sure there's more.
Sure.
Trade disruption. Go ahead.
Trade disruption we left off on. Then there's political risk coverage. This is really a subset, I would say, to the trade disruption insurance that we just discussed, and it's primarily oriented to a limited part of the entire trade disruption exposure. Some of the typical political risks are revolution or insurrection, civil unrest, terrorism, war, governmental confiscation. Another piece, just to get the ball moving on this, is credit or accounts receivable insurance, and this is really a policy to cover the payment risk. Credit insurance usually covers a portfolio of a company's buyers, customers, and it pays an agreed percentage of that invoice or that receivable that remains unpaid as a result of default or insolvency or bankruptcy. Another thing that a company needs to consider in this wall of protection is the indemnity agreements that they enter into. While these agreements are not technically an insurance policy, it really needs to be considered as a critical brick in your wall of protection. These agreements deal with a number of policies that a customer requires the vendor to maintain. I would have to say that this is probably one of the most misunderstood and most uninsured supply chain risks among food industry businesses. The biggest misconception is that insurance covers all of the risks that are stipulated within these agreements, and in short, insurance doesn't cover all of the risks. The uninsured loss potential is enormous, and this issue really needs to be looked at very closely.
Well, Michael, I'm glad I have you on the call today. I know I have a lot of clients that are concerned about how an outbreak really impacts their business, and your particular expertise on insurance, particularly outside of the indemnity agreement, really would help us understand that. And what's the most misunderstood of all the things you just talked about?
Well, definitely outside of the indemnity agreement issue, I would say the most misunderstood brick is the product contamination, product recall insurance. No doubt about it, it's been the most misunderstood.
Well, that's outstanding. Our group is called the Product Recall and Response Group and Contamination Group. That's what we're interested in. Could you tell us a little bit more why it's so misunderstood and why it could help my clients?
Sure. Well, first of all, many businesses or many of my clients and prospective clients that I speak to in the food industry, they're under a belief that if they have product liability, which is one of the bricks that we discussed, if they have product liability insurance, that they are covered for a contamination recall event, and this is not the case. Certain aspects of a contamination event can be covered by a liability policy. For example, if a company sells contaminated goods and the consumption of those goods leads to people getting sick, the insured is on the hook for the medical expenses and other damages suffered by the customer. this is a situation where products liability coverage would definitely kick in. But it will not kick in for a company's first-party losses, such as the replacement value of the contaminated product, or the company's loss of gross profits, or the consequential loss of gross profits to the insured's customers. In some cases, there may be access to a small bucket of money under a liability policy, but that's only for pure recall expenses, such as the transportation to get contaminated goods back into your possession. But this limit that is offered is usually a very small amount, such as $25,000, and in most cases, it would probably never be triggered based on the wording of the liability policy.
Wow, that's really helpful information, because I have a client that suffered a $10 million challenge from one of their consuming
Wow.
product, the damage, and I think if you could help us understand on how my clients just can't rely on liability coverage just to cover their expenses on a contamination recall event. Let's focus for a minute on standalone contamination recall policies. Why is this policy so controversial and misunderstood?
Well, as it stands now, Andy, there's probably 10 to 12 contamination recall policy forms in the marketplace. So what this has done, it's created a very competitive atmosphere in the insurance marketplace, which isn't necessarily a bad thing for potential insurers. However, these policies are very, very complex, and all of these forms have drastic differences. No one form is the same as another form. I've noticed that many insurers will allow price to drive their decision. Without proper analysis of the coverage form, making the decision to buy based on the lowest price can lead to a poor use of premium dollars and potentially devastating uninsured losses.
Wow. Can you give me some specific examples? Because I really don't understand all the policies you just mentioned, other than there are policies out there.
Right. Well, the first thing that I like to evaluate with my clients or potential clients is what I call the coverage trigger. The coverage trigger being the events or the series of events that must take place in order to produce a covered event under that particular policy. In some policies, contamination recall policies, I have seen coverage trigger wording that states that coverage will trigger if the insured's product may be contaminated and consumption of that product may lead to bodily injury. Now, on the other hand, I've seen policies that in order for coverage to trigger, the insured's product must be contaminated and consumption of that product must lead to bodily injury. There is a huge difference between the words may and must. That is one prime example of a difference that I've seen between different policy forms out there in the marketplace.
Very interesting, Michael. So it seems as though some policies will cover you in the event of a possible contamination event, while others will only cover you in the event of an actual event. That's right. Can you give me another example of the difference between policy forms?
Sure. When evaluating the overall impact of a contamination recall event, I look at the potential physical loss of the product. Now, when you're doing this, when you're evaluating the potential physical loss of product, you have to look at not only those products that are sold to customers, but also the products that could still be in the possession of the insured, sitting in their warehouse or sitting in a public warehouse somewhere across the United States or around the world. In many cases, the value of the product that's still in the possession of the insured can easily amount to more than the product that is out there already sold to their customers. However,